Hello friends, this is Vijay Bhambwani here and I'm back with you in this video to talk about the very challenging week that we saw in the market last week. If you've been around with me for a couple of weeks now or at least a couple of months, you would have seen how this shouldn't exactly have surprised you. There were warning signs being given out here and my videos, thumbnails and the topics therein were sending you red flags constantly, in addition to the live mint columns that I have been writing and sharing with people on my social media pages. So, a lot of people got very kind of amazed or confounded or even basically put off by the unusual recommendation that I made last week, which was investing money in sovereign debt schemes. Especially my younger viewers have been possibly surprised here. I can understand because from where I learned from my coach in boxing during my teens, a good boxer should know how to hit and also take hits. And during the periods of taking punches, you basically hunker down and you focus on not hitting the floor. My recommendation last week was basically to hunker down, get into a defensive position because, like I told you, the impetus charts, etc., which we are going to visit again, were very clearly giving us warning signs. So we were bracing up for a rough ride, which actually came. And like I told you last week, I personally did just that. I actually went up and raised my exposure to sovereign paper. So I'm pretty cool about it. And I recorded a video in July about why traders refuse to accept hard facts. The link to that video is either up here in the corner, or if you're watching this video on older mobile phones, they could be found in the description below the video itself. Now, this is a behavioral aspect of trading as to why, in spite of overwhelming evidence, traders tend to ignore the compelling case for a trade going against them. Please do not fall into that pitfall. Avoid, watch this video and avoid getting sucked into these traps in the market. So, going forward, we want to go forward and see what lies ahead for us. Now, the market roundup window tells you that the bank Nifty actually fell a lot more than the Nifty. Well, I warned you beforehand in my earlier videos that the RBI retail direct scheme, which is allowing the retail investors to access the bond market, would eat into the bank FD markets and impact banking stocks. My hypothesis, even though ahead of its time and seemingly a little aggressive, was absolutely right. It was on the ball, and you saw the bank Nifty falling more than the Nifty 50. Bullion fell because the Dixie, which is the US dollar index, remained firm, and the sell off on Black Friday saw a broad based selling, and there was a flight to cash, if you want to call it that. Traders were selling in a panic, and the panic is far from logical. Oil fell, which I have been advocating for months on my social media accounts. If you care to connect with me, you can update yourself daily about what I put up out here. Natural gas shot up on geopolitical events and also the approaching winter. Now, the Dixie was more or less unchanged, but the rupee weakened against the dollar, which is inflationary for us. Remember, everything that we import becomes more expensive. Now, this is also something that I've been warning you in my videos, my live mint columns, since many weeks. As a matter of fact, I sent a reminder of the dollar warning via a free WhatsApp message last week to my broadcast list, which is received by a few thousand recipients. And I did get a lot of positive response in appreciation of that. It was a reminder about what I wrote in my live mint column, what I had said in my Equity Master videos. that if the dollar appreciated, there would be problems for emerging markets, including India. If you would like to be included in the broadcast list, do send me an email on the ID that you see up here in the corner. And note, I do not give stock tips or answer trade queries. I'll just bore you with market gyan that you can act on. So the 10-year benchmark bond yield fell as bond prices rose on defensive buying on inflationary concerns. Inflation is something else that I have been going toe to toe against popular and, in my humble opinion, delusionary belief that inflation will be transitory. The real impact will be felt in 2022 by traders. And this is going to be a worldwide universal phenomena. So consider your tomato prices only as a trailer of what is likely to come. Like I said, it's a worldwide phenomena. The FAO, or Food and Agricultural Organization, has been warning about it for many months, and the tough inflation part is yet to come. So the impact on financial markets due to inflation will also be universal, and the NSE lost 3.21% in market capitalization, which is huge compared to the fact that it occurred in a week itself. Now, the MWPL chart on your screen shows a routine fall on expiry, which is along expected lines. And on your screen now is the basis chart, which shows futures premia rose on a week-on-week basis, which is also routine because traders get 4 full weeks to play with in a new derivative cycle and are therefore willing to pay higher premium. What I am concerned about, frankly, in the weeks going forward is sustained inversion, which means futures trading at a discount to cash, which is also known as ulta badla or unda badla by old hands. Now, what really happens is around expiry time of a derivative cycle, the next month futures will be available at a price lower than the current month future. This is called backwardation. And bulls will be tempted to say, okay, let me carry forward my long position to the next month because next month is actually trading lower. You know what? Bang, bang. The next month markets fall. So this is a trap that you must avoid at all costs if sustained backwardation and inversion is seen in the futures. I'll of course be updating you on social media about it proactively. Now let's take a look at the index and stock futures volumes chart. Do remember this is cumulative 3 derivative cycles, which is December, January and February futures. Volumes were seen rising on a week-on-week basis in the index futures. Part of it can be attributed to the expiry. On the other hand, stock futures volumes were more or less flat. Now this is a sign of concern because I feel traders simply froze up during the crippling decline last week and they seem to be stuck with long positions. Now, volume figures I update on my chart every day, and you can connect with me on social media to get yourself updated day to day. Now, for the most reliable and exclusive in-house study that I have ever shared with you, and something that has stood the test of time for you since many months, I'm referring to the impetus chart, which is on your screen. And unfortunately, it shows a screamingly high crescendo level rally in both the indices. Now that shows the force of the current move, and the current move is downwards. Unfortunately for retail traders, I've told you that ideally the price and impetus must rise together for a rally to sustain. However, both are moving now in opposite directions. The price is down and the impetus is up. That means the downward movement is actually gaining traction. Not good for bulls. Now, this is not just a red flag, but I think it's a full-fledged siren. This is why I told you to run for cover last week and go into sovereign debt temporarily. Now, which of course is at the other end of the extreme on my Jensen's measure and Sortino ratio metrics of our in-house statistical model, the IBEX. Now, money is actually like a chess piece for us traders. It must be ready to move from one square to the other on the chessboard we call the market. Remember, you can always revert back to the previous square later on as soon as clarity emerges. The idea is to survive during a drawdown phase without loss to capital. Now, that's extremely crucial. That puts us ahead of the guys who went down and have to climb back again. Check out on your screen how crippling losses can be. When you lose 20% capital, you need to earn 25% profit to get back to ground zero. When you lose 50% of your capital, it means you need 100% profit on the remaining capital just to get even. And the brokerage and other costs are not even included. So the climb has to be much more harder and higher. Now, these are lessons from the past declines that traders have learned, and those who have learned this lesson have a distinct advantage over those who haven't. As the saying from Hegel says, the lesson that we learn from history is that most do not learn from history. That's unfortunate. Please don't make that mistake here. Now, friends, let's go and take a look at the footprint of 4 different types of traders. Let's first start with the FIIs, the foreign investment institutions, whose index futures longs have gone to 30,099 lots from last week's 13,825 lots. Their stock futures exposure has turned positive to 38,692 lots, which was negative or net short last week of 77,424 lots. So clearly the FIIs have bought at lower levels in the futures space. Now for the DIIs, the domestic investment institutions, they have cut their net futures short positions to 71,719 lots from last week's 73,886 lots. Stocks, in stock futures, they remained net short and added to their shorts to 15,81,535 lots, which last week was 15,45,006 lots. Let's now go to the prop traders, who are the next best thing to insiders because these are brokers' own proprietary trades. They've basically added index futures longs to 18,740 lots, which was earlier 12,081 lots last week. Their individual stock futures long positions have gone down to 2,20,058 lots, which was last week 2,29,652 lots. So here now the most clued on traders, the prop traders, are actually cutting their long positions. What's the retail guys doing? Now they have basically added on to their index long positions to 2,20,880 lots, which was 47,980 lots. And their stock futures positions, they have cut down to 13,22,785 lots, which was last week 14,11,842 lots. Way to go, guys. The retail guys have shown tremendous amount of street smart by booking profits and cutting their long positions, because these are still holding the lion's share of long positions, and many may be inexperienced to take losses of this magnitude. Now, this I wrote in my live mint column and I sent you via WhatsApp. Please do connect with me and get updated here with links to my live mint columns, equity master videos, etc. Now, this is the aspect which I call the weakest link in the chain in the markets today. Majority of concentrated buy positions in retail hands. I'll keep you updated. That's an assurance. Friends, let's now go to the market that most people don't even talk about, the bond market. But we have been diligently covering it for years for you. Now, the 10-year benchmark bond yield fell slightly because flight to safety was seen last week. Economic Times reported that NRIs were buying sovereign guaranteed bonds in sizable amounts from the retail direct GSEC scheme, which I talked about. And this, of course, has exerted downward sentimental pressure on banking stocks. And because FD interest rates are lower and only guaranteed up to 5 lakhs, whereas sovereign guaranteed bonds are 100% protected. Now, this is why I love tracking the bond markets, because it's a big boys club and also the fountain of money supply for other markets. So if you're a Bank Nifty trader, you may ignore the bond yields at your own risk. I expect yields to remain under pressure for the next few days and rise higher over time. We'll continue to nibble at sovereign 10-year paper. I told you last week I'm turning towards sovereign investments. I'll continue to nibble bit by bit because I am temporarily moving my chess pieces on the market board towards risk-off investments. Friends, let's now go to the US dollar index, the Dixie, which was unchanged. It rose on 3 out of 5 trading sessions last week, but the decline on Black Friday was sizable enough to wipe out all the gains. If you cared to follow me on social media, I've been loud and very clear about inflation being far from transitory and providing you with enough data to enable you yourself to arrive at the right decision for your own self. Inflation has spooked global markets into a sell-off, and the Dixie was also caught in that downward spiral. The price stays above its 25-day exponential moving average, which is approximately 1 month of holding on cost of the bulls. As long as the current market price is higher than the 25-day average, bulls are okay in the short term. Turning to the weekly chart, we can see that the inverted hammer has been formed on the last week itself. This happens when the open and close of the weekly range is in the lower end of the range after an abortive rally intra-week. It indicates weakness in the bull camp. That means the next week's high, the week's high at 96.94 must be overcome on the upside if a new up move is to commence. The price is still comfortably above its 25-week exponential moving average, which indicates approximately 6 months of average cost, which means the medium-term outlook is positive. The uptrend remains intact. Last week, I advocated a range between 97.10 on the upside and 95.05 on the downside, which held perfectly well in spite of the extreme volatility. The coming week, you can see an estimated range between 97.10 and 95.05 again. Watch this index with hawk eyes because everything from bond prices, equities, commodity prices, etc. will depend on it. Emerging markets, including India, are vulnerable to a strong dollar and run a risk of running imported inflation. Stay sharp, my friends, and pay attention to the US dollar index extremely carefully. Let no one convince you otherwise that the US dollar index does not matter. Friends, let's now move to the Bank Nifty, which lost 5.14% on a week-on-week basis after it fell on 3 out of 5 trading sessions. But the falls were sizably larger than the small half-hearted rallies. Note that the impetus chart had shown a steep rise when the price had collapsed. Now, the price has continued to remain below its 25-day exponential moving average, which is a monthly holding on cost of the bulls. The price stays below the monthly average for 12 trading sessions now in a row. The bulls are clearly nervous and margin calls are adding to that stress. Moving to the weekly chart, I see 3 weeks of consecutive declines. The 25-week exponential moving average, which is approximately 6 months average holding on cost, has been violated. Even the medium-term buy and hold guys are losing money. Remember, I was the earliest, one of the earliest guys to tell you that the bond market would possibly impact the future FD collection of bankers, and the markets for banking stocks and Bank Nifty would worry. I believe in being ahead of the curve, even if it means appearing to be wrong in the near term. Through my videos, I'm trying to get across these ideas to make my viewers ahead of the curve as well. Now, the 34,000 level on the Bank Nifty in the spot segment needs watching in the coming weeks as the litmus test of the bulls. In the week before last, this index was number 63 on the most volatile list, which I warned you as a red flag. Last week, it rose sharply by 59 notches to number 4. Now, this is a humongous rise in volatility, and that's something that I'm worried about for my retail friends. Now, that's the kind of volatility that high impetus has brought about, along with 3 basis points decline in bond yields. If you ignore any one factor that you must watch the market punishes you severely. Last week, I advocated a range between 39,450 on the upside and 36,500 on the downside, which was violated because the low was 35,904. However, do remember that I had specifically warned you that there was a risk of breach of the ranges on the downside because of high volatility, and that's precisely what happened. The coming week is likely to see a range between 37,550 on the upside and 34,450 on the downside. In the coming week also, I expect a possibility of a breach on the downside because of volatility being higher. I would suggest you trade light because volatility is now at a deafening level, and a prudent trader should ideally focus on capital preservation first. Friends, now I move on to the Nifty 50, which lost 4.16% after falling on 3 out of 5 trading sessions. And here again, the falls were sizable compared to the minuscule gains. The impact of the impetus chart was evident on the viciousness of the decline, and the price is now below its 25-day exponential moving average, which is approximately 1 month long buyers holding on cost. The buy and hold buyers here are under pressure, though not as much as the Bank Nifty bulls. Realistically speaking, from a statistical point of view, this is the first serious correction of the ongoing rally that started in the end of March 2020. Now, this is possibly coming as a shocker to newbies who thought markets only went one way, that is upwards. Now, if you've been following me on social media, I've been raising red flags often enough around after Diwali. Now, as a matter of fact, my few favorite buys on Diwali in Equity Masters videos, of the 2 favorite buys that one was the Nifty ETF, the Nifty 50 ETF, and the other was the Indian 10-year benchmark bond yield. Of course, there were some viewers who found that humorous and their comments suggested that. But now you see why I was so guarded, because I have been on a risk-off mode since a couple of weeks. If you recollect, in my previous week's video also, I said I'm raising allocation to sovereign schemes, something that I intend to continue this week as well. I find no compelling reason to go into fresh aggressive buying right now. Of course, we can always take a dip at a later date whenever the markets do look like they are stabilizing. If you're, of course, holding long-term core portfolios, don't take any of my red flags as a sign of reversal in the long term. I'm addressing traders here, not long-term investors. The weekly chart on your screen, on the other hand, shows that the price may have fallen the price has fallen definitely for the second week in a row, but it's still above its 25-week exponential moving average, which is a 6-month average holding on cost of a bull. Now, there is a slight glimmer of hope as long as this level is intact, and the Bank Nifty is in this regard much weaker than the Nifty 50. The bull camp, however, must really try hard to bounce back or watch their initiative slip out of their control. In the week before last, this index was number 112 on the most volatile list, but it jumped very sharply, 105 notches as a matter of fact, to number 7. This is telling you just how much volatility has spiked. Last week, I advocated a range between 18,225 and 17,300, which, like the Bank Nifty, was violated on the downside. But to be fair to me, I had warned you it might happen due to the sheer volatility. Now, you can see that the bears have really stretched the weekly price bands, which is what the impetus chart is warning us about. The coming week is likely to see an estimated range between 17,500 on the upside and 16,500 on the downside. Here again, I do suspect a chance of a breach on the downside due to the sheer volatility and selling pressure. Friends, may I request you to trade really light and hold your stop losses diligently, because the price can move in either direction fairly abruptly and sharply. The Jensen's measure and Sortino ratios don't justify taking aggressive risk, so it's time to be prioritizing capital preservation over capital appreciation. Of course, one can always dive in any time after clarity emerges. Friends, this week I will skip the 5 low volatile and high volatile stocks for the simple reason that the extreme beta spikes are very challenging for many traders, and one should basically hunker down and be in capital preservation mode. I will be updating you on my social media accounts. My contact coordinates come at the fag end of this video. Before I sign off, may I request you to click like on this video, subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And I would love to hear from you in the comment section, so keep your feedback coming. Also, in the description below the video, there are links to my YouTube playlist on Equity Masters YouTube channel. Do subscribe to that channel and get my views. And also a hyperlink to a free trading guide from Equity Master. Do avail of this offer as well. I wish you have a very profitable and safe trading week, my friends. Thank you for your patience. Till we meet again in my next video. This is Vijay Bhambwani signing off for now. Thank you. Bye-bye.